Christian Putz, not a guest who has been on this series yet. This is his first appearance, but he did make an appearance on the Contrarian Investor podcast a couple of weeks ago. And on the subject of commodities, back then you were very cautiously bullish, which looked like it worked out quite all right, I would say. Since then, the oil and other base commodities have done quite well. So looking forward to seeing what you have for us today. And with that, I will turn it over to you and mute myself. Do you need me to share the thing, or can you do it?
I can do it. 1 second.
Awesome.
So, can you see it normally? Perfect. So let me quickly talk about first disclaimer. I think everyone should read it. Then about what I would like to present first shortly about our company, myself, and about the investment idea we have, which is a long idea, an Austrian IT company called S&T. Quickly about myself, I think that's quite crucial to know because that gives you a good idea where I'm coming from, and you can then better categorize my idea as well. There's this saying that forecast tells more about a forecaster than it tells about the future. It's a bit here as well. If you know how what his background is, how he's thinking, then you understand not only hopefully the investment idea, but as well whether that's something that fits your investment style. What is quite unique with us is that I have made quite some bear market experiences. I was in Russia for 5 years, working as a portfolio manager, and there the market crashed 75%. And this kind of experience shaped my investment philosophy and process, because when you experience 5 years of bear market, then you obviously care a lot about capital preservation, not losing money or even making money on the short side. And when I set up my own business, now we manage a global long-short equity strategy since 2015, then the focus I had was on one hand making good returns, and on the other hand, not losing much or even making money in those sell-offs. So the question is always, how do you do that? Obviously, there are several steps to that. One cornerstone is that you focus on those investment opportunities where you think the risk reward is really very good. And so we focus on those kind of opportunities, both on the long and on the short side. And today, I would like to present one idea on the long side. In fact, in our investment process, we have got mainly two patterns. On the long side, we focus on rebound situations and momentum situations, or profitable growth situations, and two patterns on the short side, bubble and structural losses. So on the idea we have, right, on the bottom-up stock picking, we look for those so-called dynamic profit growth situations where we think we want to be in an industry that has structural growth, is not cyclical. Then we see strong revenue and earnings growth, and of the company, ideally it's a leader in the industry. Then we see a sustainable competitive advantage, because it's all about predicting the future. And only if you think the competitive advantage is sustainable, then there's a high chance that in the future your company is worth something as well. Then obviously, ideally, you have a proven management team. And in order to, often those kind of companies, obviously, they're highly valued, right? So you have then a really great risk reward opportunity when you think the stock price correction that just happened is unrelated to business fundamentals. And we have identified several companies that meet those criteria, but one I would like to present today is S&T. For disclosure, we are long this company. We think it's at the current price a great risk return opportunity. What does S&T do? S&T is active in several segments: IT services historically, and since several years in IoT, Internet of Things, and there they have grown really strongly over the past years. They, in 2014, revenues were about 400 million euros, and now this year expected more than 1.2 billion. The good thing about Internet of Things is, as the name says already, right? And it's very complicated, very complex. And for that reason, what you have is, if you have clients like Siemens, General Electric, etc., once you implement their system, you know that these clients, there's a low chance that they will move, that they will switch to another system. So you have very sticky clients. So what we see is that in the IoT industry, right, we obviously had, we've seen with S&T, we had quite some significant growth in the last years. But when you listen to some forecasters, some industry experts, like for example, Gartner, etc., then you see that we're just in the beginning of this big sectoral or structural trend. So we are now here, right? And for example, Statista, there's a prediction that this IoT trend increases massively in the coming years. In fact, we will see some exponential growth there, which even with COVID, COVID, I would say, makes it even more probable. We will see obviously in the coming years then whether that happens. So when we look at S&T, they're active in two main things, like IT services and industrial Internet of Things, right? And they made quite a development over the past years. So they acquired a company in Germany called Contrarian, which provides motherboards. So they provide the full service to clients. So they have the hardware, they have the software, and because they have the IT service that they offer as well, they also help companies in customizing then their systems. So they can really provide the whole service range there. So, and they developed their own system. It's called SUSITech, and obviously make quite some acquisitions. And on top of it, work together with companies like Foxconn, which is also a major shareholder in S&T. And the major clients, or in total, they have more than 3,000 clients. The biggest client is less % of their revenues. And among the clients, they have obviously the big industrial companies in Europe, like Siemens, BMW, and so on. Then, one other reason why the company, catched our attention is really that the business is non-cyclical, right? And that's quite attractive because obviously it's quite hard to predict where the future is going. But if you have a business that is profiting from a strong structural trend, then there's a high chance that, especially if they have an industry-leading position, going forward, the growth will continue. And we saw with S&T that in the last almost 12 years now, they had consistently growing revenue and EBITDA. And even now, in the recent panic, let's say in Q2, when COVID was really at its worst, the company managed to increase their backlog, and they even exceeded the expectations and increased their outlook for this year. So despite this uncertain economic year, they managed nevertheless to grow. And what is also quite important, they have very low debt or no debt. And going forward, what do they want to do? They want to acquire even more companies. So they want to grow even faster. They have this plan now till 2023. They want to increase the revenue by about 70%, half of it, or a little bit more than half of it via acquisitions. Normally, when companies or management tells me, okay, they want to grow via acquisitions, I'm quite cautious, because the reality is that a lot of acquisitions, a lot of mergers, they are not that successful, as management often wishes, right? When I look at the track record of S&T, I see that in fact their track record is quite good. We see it also in the last quarters. When there was this panic in the second quarter, they really use this uncertainty to buy several companies at relatively low valuations. I mean, now obviously valuations of IT companies increased massively over the last months. We have seen this massive boom in the stock market, but in the second quarter, I mean, there was a lot of uncertainty, and they managed to acquire several companies at really low valuations, which is really a good sign, I would say, and speaks for them. The other thing as well, when I look at their other acquisitions they did in the last years, it was often companies that were loss-making, and they successfully turned them around. I mean, that's really the specialization of the CEO. And obviously, valuations of loss-making companies are in general quite low, right? When you really make them profitable then and have growth, then automatically the multiples increase. So what happened then is in the last years that on one hand, obviously the revenue grew, but as well, by making those companies they bought, the EBITDA margins increased. And obviously with the recent acquisitions, if they manage to turn them around, the EBITDA margin is expected to increase further. So it seems like, I mean, when you just look at it, you know, very strong growth in the past years. The stock price as well had really good performance till about 2017. And this year, in fact, despite the rally we saw in many tech companies, the stock did not really perform very much. Among probably different reasons, but the biggest one is there was a short selling attack, one can say. And obviously in Europe, we had several cases this year where, I mean, there were huge scandals. We had Wirecard, Grenke. So if people wrote about companies telling that there might be some fraudulent activity going on, a lot of people got extremely cautious and, you know, I would say rather sold immediately and later on check in detail on what's going on. With S&T, it was the same. I mean, there was one short-focused research house in the UK writing quite a negative report on them. We had a look into those, you know, accusations and talked as well with management, etc. And we've decided for ourselves that, I mean, those accusations are quite one-sided and do not really make a lot of sense as well. I mean, it's about the technology which they have, where the accusation is, I mean, that's really no competitive advantage. But I have the impression the analyst there doesn't really understand that, I mean, at the end of the day, it's the full service they offer, from hardware to software to, you know, IT service that helps them in customizing the products they offer. And it's quite different to, for example, cloud computing, where, I mean, the solutions are quite standardized. Then on top of it, I mean, there were some accusations in terms of exaggerating EBITDA. But when we looked at how this research analyst, you know, came up with their numbers, we decided, okay, that doesn't make any sense at all. And obviously, the other point of criticism is the acquisitions. And I fully understand that, because acquisitions obviously had a lot of complexity. I mean, the company has grown quite a lot in recent years. But when you look at the cash flow numbers and the cash they have on balance sheet, I would say that with the recent acquisitions that were really well timed, I would say that, I mean, this is one of the rare companies, I would say, that has a successful track record in doing acquisitions. So here's why we think this is a great risk-reward opportunity. First of all, when you look at the chart, you see that over the years, I mean, that's the purple line is the stock price. The yellow line is the P ratio. So, I mean, the P ratio went up obviously a lot in the past when they had strong growth. And in the last years, despite the company increasing their EPS, the valuation came down quite significantly. And now, why do I think right at this point it's a great opportunity? I think obviously on one hand, the revenue or the growth outlook is quite good, but as well, the company changed the policy or the shareholder incentive structure. One can say, well, a better word is what they started doing is they started a share buyback. So I would say that, you know, given that they just started a share buyback, the risk on the downside is quite limited. On top of it, obviously, valuations now are really at low levels. And thirdly, management, the CEO, recently in the last 2 months bought shares as well, like the CEO bought shares worth about 1 million euros. For an Austrian CEO, I would say that's quite a lot of money. So I clearly see that, you know, the management has confidence in the company. And on top of it, what they changed as well is because they think, okay, valuation is really cheap, they want to spend 50% of the net profits they generate, either by buying back shares or by, you know, sharing those profits with shareholders by paying dividends. So once more, I mean, that's really why we think the risk reward here is very good, especially currently at those price levels. You know, growth company, experienced management team, very strong operating and financial metrics. And in our opinion, it has been sold off for the wrong reasons. When you look at those accusations, they are, in my opinion, not really well researched. And for that reason, I think, especially now, is a good entry point for the stock. That's is from my side. If there are any questions, I'm more than happy to.
Yeah, thanks. There's one question here that we have, a non-public report by the analyst. Oh,
yeah, exactly. That's the research report. That's really interesting, right? Because they wrote about S&T, and the interesting thing there is, in my opinion, that one of the reasons why the stock reacted so badly was that the management team, or let's better put the IR team, reacted quite badly on that, because obviously it's not a non-public report, and you know, at the end of the day, if it's non-public, you don't really have to react to it. But they, in October, when there was a lot of uncertainty with COVID cases and the markets were falling, they issued you know, an announcement saying you know, a short selling house is writing about us, and it was for the first week, I mean, it was completely unclear who was writing that, and even me, I didn't know. I mean, I had to call around to find out who was writing this report. So I think there was a lot of uncertainty. No one exactly knew who this short seller is, and in this general panic sell-off before the election in the US, people just decided, okay, you know, maybe that's another wirecard case, and the stock corrected. Obviously, since then, you know, the stock bounced back quite a bit, has seen quite a big rally from the lows. But I think, you know, I mean, we ourselves, I mean, our target price is about, you know, about 30. Obviously, there's still massive upside.
About 30 euros, and it's trading around just short of 19. It looks like. The and yeah, this is apparently the most highly shorted stock among Austrian listed companies. What is the general bear case? Is it all because of that report, or is it what do you view of that, and why do you?
I mean, I think the main reason is really the report, right? Although I'm a bit surprised, because when you dig into the number, and obviously the company as well reacted to the short report on their website, you find all the accusations and all their responses. And when you read through them, and my analyst was working as an auditor before as well, it doesn't really make sense in many regards.
Interesting. All right. Are there any? I'm sorry. Go ahead.
No, I mean, I just saw the other questions about Österreichische Post.
Österreichische Post, yeah. Yeah. Any views on that?
Yeah, I mean, I know that it is quite shorted. I don't know exactly why in the details, but I guess among others, it's because they're facing increasing competition from Amazon. For that reason, Amazon has built up their own logistical system in Austria. And I think that's the main reason.
Okay. Interesting. Okay. And then what, as far as comparables, like what is this company most comparable to, would you say? Like who is their competition?
I mean, when you look at the biggest listed competitors, I mean, one is Advantech in Asia. I mean, that's the biggest, I would say, listed competitor.
Okay. And lastly, I was also from the panelists. Have things changed in Germany and Austria following the WDI scandal? Are there any differences in approach by regulators?
Yeah, I wouldn't say not much has changed, honestly. I mean, obviously, I mean, I hope that, I mean, I in fact also, gave some interviews in one of the Austrian press. And the issue in general is, I would say in Germany and Austria, that if you run a hedge fund, you're always automatically the evil person,
right? And
company management is always good, and they, the hedge fund guys or the private equity guys are the bad guys who want to, just fire people and don't care about employees. I think the Wirecard scandal has well shown that this is not like that, and as well that I mean, obviously, a lot of people in the DACH region, Germany, Austria, Switzerland, they don't fully understand shorting, and they obviously think it's bad, it should be forbidden. But I think this crisis has as well shown very well the value added of being able to short, right? Because the reality is, as a short seller, your incentives to detect fraud is much higher than if you're an employee of of a state agency who is responsible for detecting those frauds, right? Because, if you're right, you can make a lot of money. Whereas if you're a state employee, you have a 9-to-5 job, at the end of the day, the incentives to really detecting fraud are not that high. But, and, I would say still a lot, there's, the regulatory bodies there, they slowly maybe, realize that. But in general, I would say the attitude is still more like, I mean, the hedge funds, they're bad, and companies are great, and management is creating jobs.
Yeah. Well, that's it seems to be pretty entrenched. Very good. Awesome. Christian Putz, thank you so much for doing that.